Hello friends, welcome back to another interesting session on cash flow statement. So far we have decoded investing activities and financing activities. Now in today's session we will decode operating activities. What are the items to be taken care of? From where we have to extract the information so that we will be able to ascertain the cash flow from operating activities. And finally I will show you how an entire cash flow statement when we put together is formed. For understanding purpose, please go refer and watch the videos where I have decoded the financing activity and investing activities separately so that you'll be able to understand how to prepare the cash flow statement in full, which is going to be explained in this video. Now, it is the same question that I've used for the investing and financing activity, and if you have already watched the video, you will know what are the items we've already dealt with. In financing activity, we have used the share capital, we have used the long-term borrowing for financing activity and short-term borrowing for financing activity. Then we have taken the tangible assets for investing activity, non-current investment for investing activity, and that's it. We are left with these items, that is reserves and surplus. We have to go and see in the note number 1 what does it comprise of. Then we have the short-term provisions, note number 4, and then we have the intangible assets. Intangible assets can be part of investing or operating activity in the sense that if there's an increase from previous year to current year, then there might have been further investment made. But here, as I discussed in operating activity, it is a decrease, which means that intangible assets have been written off, and therefore what was written off would be shown in the operating activity. So that is why this would be a part in this case of the operating activity. Other than that, this current investment would be a part of your cash and cash equivalent, and there is also cash and cash equivalent here. It would get added, and then the inventories would be a part of operating activity. That is, the changes which take place in the working capital, which is adjusted, would be shown here. So now let us focus on operating activity and understand it. So we have reserves and surplus, note number 1. Let us go and look at that. It comprises of only the surplus, that is balance statement of profit and loss account. What has happened? It was 3 lakh. It has changed to 6 lakh. So it has increased. The addition is on account of the net profit for the year which got added up. What is the surplus which was left got added up and is now shown in the balance sheet. This would be your starting point. The cash flow from operating activity always starts with the net profit before tax and extraordinary item. So we have to calculate the net profit before tax and extraordinary item, and for that working note, the starting point would be the difference in this surplus. So let us see that here we will write first one, net profit before tax and extraordinary items. We will prepare a working note for that. So in the working note number 1, which is for net profit before tax and extraordinary items, as I told you, the starting point is going to be the difference in surplus. So difference in surplus, that is the closing balance minus the opening balance in the surplus. Now what is that? That is this amount. Closing is 6 lakh, opening is 3 lakh. So 6 lakh minus 3 lakh. So that would be written here, 6 lakh minus 3 lakh. So 3 lakh is the net profit of the year. Now there are certain items which are added and subtracted. Now for example, I will tell you what are the common things that will be added and subtracted. Then we'll come to the relevant thing in this question. Normally what is added is the provision for tax of the current year. I'll write it here. Provision for tax of the current year. The dividend, whether it is interim or final dividend which has been paid during the year. If there is any transfer to general reserve, then that would be added. So these items are normally added, and the items which are subtracted or if there is any refund of tax, that is subtract. If there are any extraordinary items of losses, then that is normally added, and if there is any extraordinary items of gain, that would be subtracted, because this is net profit before tax and extraordinary items. We are going to adjust that. So these are the common things which would come in this particular working note. Now let us come to the specific question and see what are the items. We have to see find out what is the provision of tax for current year if it is given, if there is a dividend paid, the transfer to reserve or extraordinary items, refund of tax or extraordinary gain. Keeping that in mind, let us look at this question. So here we have, for provision for tax, we have to see short term provision, note number 4. So look at note number 4. Short term provision is provision for tax. They have given that 1,65,000 as on 31st March 2017 and 2 lakh as on 31st March 2018. Now always when only these two information are given, we would assume that the opening was the tax which was paid during the year, and whatever is the closing we have, it is a current year provision that has been created. If, going to the additional information, if there was information about the tax paid during the year or provision of tax for the current year, then you go ahead and prepare a provision for tax account to find the other balancing figure, whatever is not given. But in this case, no additional information is there. So what do? We take simple, the opening provision would be the tax paid during the current year. So in the operating activity, the last item before finding out the cash flow from operating activity, there is a tax paid which is deducted. That is this 1,65,000. And in the note number 1, in the computation of that net profit before tax and extraordinary item, the tax which we add back as current year provision is this 2 lakh. So this 2 lakh is what we are supposed to write here. Provision for tax of current year, 2 lakh. And let's see whether there's any other thing. In reserves, there is no general reserve, so forget it. Then other than that, is there any other thing related to the items that I told you? No, there is nothing as such given here. There is no dividend paid, nothing. So that's it. Our note, this one is short. You can also include it in the cash flow statement when instead of preparing working note. When there are multiple items, better to prepare a working note. When there are so many items, prepare a working note, put the amount in the cash flow statement and operating activity, or if there is only simple 1 or 2 items, you can directly take it also, but always working note makes your presentation better. So the amount of net profit before tax and extra item to be taken is here 5 lakhs. So that's a starting point of our cash flow from operating activity. With this, we would be adding and subtracting certain items. What do we add? We add non-cash and non-operating items. So non-cash expense, non-operating expenses and losses, if any, are added, and there would be subtraction of any non-operating incomes or gains. So I'll leave around 3 lines and I will write this for non-operating income or gains. Now if you have viewed the previous videos, you would know in investing activity we had prepared the machinery account. So I'll just show you the machinery account which we had prepared. It was like this. So here you find machinery account, opening balance, closing balance. This amount that we have is the gain on sale. So this is the non-operating gain. This is not operating gain. This is the amount which you'll be subtracting. Other than that, we have non-cash expense of depreciation which we have to take from here. This is 1,40,000. When we prepared the accumulated depreciation account, we got 1,40,000 as a depreciation, which is a non-cash expense which we have to add up. So these are the 2 items which is relevant, which we have to remember to take in our operating activity cash flow statement. So under non-cash expense, we have depreciation of 1,40,000 and gain on sale of machinery was a non-operating gain. So that has to be subtracted 10,000 here. Other than that, if you remember the previous video on financing activity, we had calculated the debentures interest. So we had calculated the debenture interest as the debentures were issued at the beginning on entire 5,12,000 60,000, which we said that interest was paid and there was outflow. But this would have been subtracted in a profit and loss account, arriving at that net profit. So that is a non-operating, it's a financing activity part. So that has got deducted in arriving at that net profit. So that is an item of non-operating expense which got deducted. Therefore, we have to add back. So that is why interest on 12% debentures have to be added back here. We add it back here and we show it as an outflow in financing activity. And then finally, the other one point that I told you was about the intangible assets goodwill. Normally, intangible assets, if there's an increase, that would be represented by purchase of intangible asset and investing activity. But here, what has happened? This we find from 3 lakh has gone down to 2 lakh. So there is a decrease. When there's a decrease, it represents amortization. When it is intangible assets, it is written off, we call it as amortization. Therefore, we have to take this as a part of our non-cash expense here. It is goodwill written off or amortized 1 lakh. So this way done. We are done with these items. There is nothing else here. So we'll total it up. 2 lakh, 3 lakh here. So 8 lakh. And this is an out subtract item. So we are left with 7,19,000. So this is nothing but called as operating profit before working capital changes. Now next what we have to focus upon is the working capital part. So going back here, we have to look at, we have taken care of this part, operating part. We have used the provision for tax part. We are going to use the paid one now further, that is pending. We have dealt with the intangible asset being written off. Now the working capital part, you find there is no other thing here in the current liability. What does working capital comprise of? Think. It comprises of current assets and current liabilities. In current liabilities, if you have sundry creditors or bills payable, then that would be or outstanding expense, that would have been the part of operating activity, working capital changes. And the current asset part like debtors, inventories, all those would have come under current asset. If you observe here, there is only one item, inventories, which has undergone a change. What has happened? It was 40,000. It is 1,30,000 which has changed to 2,60,000. So this is represented by inventories. So what has happened? 1,30,000 increase in current asset. Now very important thing that you have to remember is what is to be added and what is to be subtracted. Now I'll tell you here, in respect of working capital changes, you just make a note of this. We add whenever there is an increase in current liability and decrease in current asset, and we subtract when there is an increase in current asset and decrease in current liability. So whenever current asset decreases, it means there's an inflow, or if current liability increases, it means you have not allowed an outflow to take place. So that is why it's an add. Whereas if current asset increases, means you are not able to have an inflow because your current assets have increased, it is not coming in as cash. And when current liabilities decrease, it means you're paying off some liability, so there's an outflow. That is why subtract. So please note this down. By heart any one, like even if you by heart one item like decrease in current asset, you know decrease in current asset is add, then you know the opposite for current liability, increase in current liability. Once you know this, you can always remember this is the opposite. Increase in current liability here means decrease in current liability. Decrease in current asset means increase in current liability, which will be subtract. So all you have to do is just remember one thing, and rest you can decode if you're not able to remember all of them at Marco. Now in our example, what has happened? The inventory was 1,30,000, it increased to 2,60,000. So it's an increase in current asset of 1,30,000. So it's a subtract. So here we will have less increase in inventories. 1,30,000. It's a subtract item for us. So what is left here? 6,60,000. Now, one important thing, the provision for tax. We have taken the current year provision working note. What about the opening provision? I told you the opening provision would have got paid during the year. So that is tax paid. So that would have to be subtracted here. Less income tax paid. What was the amount? Just going back to this to cbse, it was 1,65,000, which you should take as paid. So 1,65,000. So once you subtract that, what you get is the cash flow from operating activities. So how much does that come to? 4,95,000 is the cash flow from operating activity. I hope now the cash flow from operating activity is also clear to you. So now just to summarize the whole thing, this is how your cash flow statement would look once you're completed. You have cash flow from operating activity, net profit before tax and extraordinary item. Net profit was the difference in surplus, 6 lakh minus 3 lakh, 3 lakh. To that we added the provision for tax 2 lakh to get 5 lakh. This was the current year provision. To that we added back the non-cash and expense and non-operating expense, that is depreciation machinery, interest on debentures and goodwill written off. And we subtracted the non-operating gain, that is profit made from the sale of the machinery, 10,000, and that yielded us operating profit before working capital changes of 7,90,000. Then we adjusted the working capital changes. In this question there was just one increase in inventory, increase in current asset is subtract, so we subtracted that to get cash generated from operations. From that we subtracted the tax paid, 1,65,000, to get the cash inflow from operating activity, 4,95,000. Now the cash flow from investing activity, from the previous video you would have learned the sale proceeds of machinery 50, purchase of machinery outflow of 6,80,000, purchase of investment 1 lakh resulted in cash being used in investing activity of 7,30,000. And cash flow from financing activity in detail, you can watch that video where we show the issue of shares of 2 lakh, issue of 12% debentures of 1 lakh leading to an inflow, and an outflow on account of bank overdraft being repaid and interest paid on debentures. Ultimately, you got cash inflow from financing activity. So the three activities, 4,95,000 plus 2,35,000 minus 7,30,000 results actually in nil amount as net increase or decrease in cash and cash equivalent. It nullifies. So normally you will get an amount. If you don't get, don't worry, it can also be like this. Then you add the cash and cash equivalents at the beginning. So opening balance of cash and cash equivalents. As I told you, cash and cash equivalent balance and the current investment has to be included here. So opening balance was 2,10,000. Closing balance of cash and cash equivalents again include the current investment, cash and cash equivalent. Found the 2,10,000. So the difference between those two is nil. There was no change. So that is another way to verify. If you have done all the three activities correctly, and when you take from the balance sheet and write the opening and closing, whatever is the difference between the opening and closing, that amount you should get here as a total of the cash flows from the three activities. If you don't get it, then it means you have made some error somewhere. You have to go searching for that error. But if you have done everything correctly, the difference between the opening and closing, cash and cash equivalent, which you get here, would be the total of the cash flows from the three activities: operating activity, investing activity and financing activity. And these are the working notes that you have to prepare: machinery account, accumulated depreciation account, provision for for tax account if required. So I hope the entire cash flow statement part has been revised thoroughly and has been decoded by you now. I hope you will be able to handle the cash flow statement with ease henceforth. In case you have any doubts or query, please feel free to comment in the comment section below, and I will definitely respond to it at the earliest. So thank you for joining me today. Have a great day. Bye bye.